Risk and return. We all know that the return earned on investments represents the marginal benefit of investing. In this lesson, we will discuss the return on common stock under uncertainty, the expected return for a single stock, the probability distribution of return, the co-movement of two assets and measuring covariance, the risk and return for a two-asset portfolio, the variance analysis of returns, and two assets portfolio. After going through this presentation, you should be able to discuss the return on common stock under uncertainty, calculate the expected return for a single stock, explain return and risk of portfolio, describe the portfolio diversification and risk. Risk represents the marginal cost of investing. A trade-off always arises between expected risk and expected return. Portfolio means a collection or combination of financial assets or securities, such as shares, debentures, and government securities. Risk and return depends on the length of the maturity period. Longer maturity periods impart greater risk to investments and the credit worthiness of the issuer of securities. The ability of the borrower to make periodical interest payments and pay back the principal amount will impart safety to the investment, and this reduces risk. Required return equals to risk-free real rate plus inflation premium plus risk premium. In formula, RT equals to rate of return per time period T. IT equals income for the period T. PT equals price at the end of time period T. PT minus 1 equals initial price, that is price at the beginning of the period T. This formula can be split into two parts. The slope of the market line indicates the return per unit of risk required by all investors. Highly risk-averse investors would have a steeper line. To deal with the uncertainty of returns, investors need to think explicitly about a security's distribution of probable total returns equals to dividends plus market prices T divided by market prices minus 1. Market prices T equals to prices at time T. The sum of probabilities of all possible outcomes must be 1. The most familiar continuous distribution is the normal distribution, depicted by the well-known bell-shaped curve often used in statistics. The expected return from a portfolio of two or more securities is equal to the weighted average of the expected returns from the individual securities. Sigma Rp equals to WA into RA plus WB into RB. Here, sigma Rp equals expected return from a portfolio of two securities. WA equals proportion of funds invested in security A. WB equals proportion of funds invested in security B. RA equals expected return of security A. RB equals expected return of security B. WA plus WB equals 1. The risk of a security is measured in terms of variance or standard deviation of its return. The portfolio risk is not simply a measure of its weighted average risk. The securities that a portfolio contains are associated with each other. The portfolio risk also considers the covariance between the returns of the investment. Covariance of two securities is a measure of their co-movement. It expresses the degree to which the securities vary together. P equals WA square into sigma A square plus WB square into sigma B square plus 2 into WA into WB into rho AB into sigma A into sigma B, where sigma P equals to standard deviation of portfolio consisting securities A and B. WAWB equals proportion of funds invested in security A and security B. Sigma A sigma B equals standard deviation of returns of security A and security B. Rho AB equals to correlation coefficient between returns of security A and security B. The correlation coefficient AB can be calculated as follows. AB equals COV AB divided by sigma A sigma B. The covariance of security A and security B can be presented as follows. COV AB equals sigma A sigma B rho. Question. The returns of security of Wipro and security of Infosys for the past 5 years are given below. Calculate the risk and return of portfolio consisting. Solution. Now first calculate the mean return and standard deviation of security Wipro. A. First calculate mean. Mean return R equals to 45 divided by 5 equals to 9%. After that calculate R minus R bar. Then the square of each element of R minus R bar. Then add all the elements of R minus R bar square, which equals to 266. Then calculate square root of 266. Standard deviation sigma A equals to square root of 110 equals to 10.49%. Calculate mean return and standard deviation of security Infosys B. First calculate mean. Mean return R equals to 40 divided by 5 equals to 8%. After that calculate R minus R bar. Then square of each element of R minus R bar. Then add all the elements of R minus R bar square, which equals to 266. Then calculate square root of 266. Standard deviation sigma B equals to square root of 266 equals to 16.31%. Analysis. Security A has a higher historic level of return and lower risk as compared to security B. Now calculate correlation coefficient rho AB. For this, first calculate x square and y square, then multiply xy. After that, put the values in the given equation. Verification. Calculation of covariance of returns of securities A and B. First calculate RA minus RA bar and RB minus RB bar. Then multiply RA minus RA bar and RB minus RB bar. Rho AB equals to COV AB divided by sigma A into sigma B equals to 84 divided by 10.49 into 16.31 equals to 0.491. Covariance AB equals to sigma A into sigma B into rho AB equals to 10.49 into 16.31 into 0.491 equals to 84. Put all the values we have calculated in the formula for calculation of return and risk. Then return of portfolio RP equals to 0.80 into 9 plus 0.20 into 8 equals to 7.2 plus 1.6 equals to 8.8%. Risk of portfolio sigma P. Rho P square equals 0.80 square into 10.49 square plus 0.20 square into 16.31 square plus 2 into 0.80 into 0.20 into 10.49 into 16.31 into 0.491 equals to 0.64 into 110.04 plus 0.04 into 266.02 plus 26.88 equals to 70.43 plus 10.64 plus 26.88 equals to 107.95. Sigma P equals to square root of 107.95 equals to 10.39%. Risk of 3 asset portfolio calculated by given formula, where W1, W2, W3 equals proportion of amount invested in securities X, Y and Z. Sigma x, sigma y, sigma z equals to standard deviations of securities x, y and z. Rho xy equals to correlation coefficient between securities x and y. Rho yz equals to correlation coefficient between securities y and z. Rho xz equals to correlation coefficient between securities x and z. The investor can minimize his risk on the portfolio. Risk avoidance and risk minimization are the important objectives of portfolio management. The minimum risk portfolio with two assets can be ascertained as follows. WA equals delta B square minus covariance AB divided by delta A square plus delta B square minus covariance AB. And return for n asset portfolio are calculated by given formula. In order to understand portfolio diversification, one must understand correlation. Correlation is a statistical measure that indicates the relationship, if any, between series of numbers representing anything from cash flows to test data. If the two series move together, they are positively correlated. If the series move in opposite directions, they are negatively correlated. The existence of perfectly correlated, especially negatively correlated projects is quite rare. In order to diversify project risk and thereby reduce the firm's overall risk, the projects that are best combined or added to the existing portfolio of projects are those that have a negative or low positive correlation with existing projects. By combining negatively correlated projects, the overall variability of returns or risk can be reduced. Now let us check if we have understood the various concepts discussed in this lesson clearly. The portfolio's expected return is an arithmetic mean of the expected returns of its securities. Right or wrong? Wrong. If the utility function is linear, the decision maker maximizes expected utility by maximizing expected monetary value. Right or wrong? Right. Higher risk equals greater return. Right or wrong? Wrong. Before we end, let us briefly revise what we have studied till so far. The risk of an asset held in a portfolio is different from that of an asset held on its own variance and can be found using the following formula. Portfolio is a collection of investments held by an institution or a private individual. Systematic risk is a risk of security that cannot be reduced through diversification. Unsystematic risk is a company or industry-specific risk that is inherent in each investment. The amount of unsystematic risk can be reduced through appropriate diversification. Beta is a coefficient that describes how the expected return of a stock or portfolio is correlated to the return of the financial market as a whole. In short, we can say there is direct relation between risk and return.